Hi, everyone, and welcome to this week's episode of Money Moves. First, I will go over my thoughts on the upcoming earnings season. Then I will go over each of my investing accounts, starting with Worthy Bonds. I will talk briefly about what I've been doing with Lending Club. Then I will go over my Fundrise account. Next will be my M1 Retire account, followed by my Higher Yield Savings account. And lastly, for my investments, I will very quickly go over my options portfolio with Robinhood, as well as my Tastyworks account. Then I will take a look at my bi-weekly tracker. For this episode, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like owning the newly redesigned Bentley Bentayga, or if you just want to be part of a well-educated financial community, definitely like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. Getting into this article, third quarter earnings kick off this week and should be much better than expected. They say in second quarter, companies delivered larger earnings beats than expected, and it seems to be happening again just with some of the early announcements in third quarter. However, they temper this expectation, stating that fourth quarter still remains hostage to the vaccine as well as economic reopenings. They say third quarter estimates are not going as usual. Usually estimates are too high and are adjusted downwards, but in this case you can see that the July estimate was down 25% and the current estimate is down only 21%. This means analysts are getting more and more bullish on earnings, which could potentially lead to higher stock market prices. Even with the upgraded expectations, 20 out of the 22 companies that have announced earnings in the S&P 500 have beat it, and they are beating it by quite a wide margin, further leading to the fact that many analysts might be underestimating the current recovery. Moving on to my investments, you can see I've left all of my money in Worthy Bonds for now, and part of that is because I continue to pull money out of Lending Club. Since Lending Club is going away, I think I'm going to leave Worthy Bonds alone for the foreseeable future. Also, you can see, I don't remember if I mentioned it last week, but Worthy Community Bonds was finally unveiled. And that's because Worthy Pure Capital and Worthy Pure Capital 2 are limited to $50 million worth of bonds by the SEC. And once they sell out, they do have to open a new fund. And they were getting pretty close to capping out Worthy Pure 2. And therefore, they had to open a new section. If you think the current stock market is volatile and you're looking for a safer place to make 5% compounded daily, there is a link in the description that will get you one free bond when you fund your account. Moving on to my Lending Club account. This is my taxable account, and in one of my previous videos, I mentioned that Lending Club is ending its retail investing. So as you can see here, I am withdrawing money as I can, and I'm moving it over to new investments. This is quite unfortunate because both my accounts continue to grow on an annualized percentage basis, and I'll just have to find somewhere else to put this money. Moving on to my Fundrise account. This account continues to grow, and over the last 2 weeks, I did deposit $500, which is my standard monthly investment. And you can see the projected account value here is just over $500,000 by May of 2040. They also announced on October 20th that 3 of their funds, the DC, LA, and National funds, were going to be combined by the end of November. And let's take a closer look at what that means. They say in order to improve economies of scale and minimize operating costs, they're going to merge 3 of these funds into a single larger fund by the end of November. Note to investors, you have the option to withdraw any money from each of these funds without penalty in order to avoid this merger if you don't want to be invested in the fund that results. Looking at the key takeaways, they reiterate 30 November is the date to be completed. Any requests to redeem money from any of these funds must be completed by 15 November. And an interesting one here is that they have decided to waive 100% of asset management and advisory fees since the inception of the funds. I wonder if that means they're going to refund us any money that was previously taken. And I'll definitely look forward to what that means in terms of account value. They say the single larger fund will focus on single-family housing in affordably constrained markets, and they will also use a tax-advantaged structure. They show how single-family homes in both Washington, D.C. and Los Angeles have grown substantially since January of 2017, all the way through July of 2020, with Los Angeles being the outperformer of the two. Once the fund is combined, it will hold approximately 75 homes and 88 potential lots, totaling around $95 million in assets under management. And once they are combined, it should reduce expenses by 0.5% annually, which doesn't sound like a lot, but 0.5% of $95 million is still substantial. They reiterate one of the topics that I've mentioned in one of my previous videos. The Rona is causing asset prices to surge because there are very few homes on the market right now, and for people to be willing to sell their homes, they want to get a premium price for that home. Those two factors combined are currently driving up housing markets pretty substantially, as you saw on the graphs previously. If you're interested in investing in funds like this, there is a link in the description that will get your advisory fees waived for the first 90 days. Moving on to my M1 Retire account, you can see this account is up just over 2.5% over the last month, which is great, but as you can see on the chart, it has been pretty choppy. And just over the last few days here, the market has declined around 2.5% in just one day. Looking at the holdings here, you can see tech still doing pretty well, but actually being outpaced by dividend ETFs, as well as consumer products. Healthcare continues to struggle. Somehow finance was up quite a bit. Short-term government bonds is down, which means people are starting to move some of that money into the markets. And these prices are also going down a little bit with the fact that the stimulus money is probably not coming in the near future. Utilities are the monstrous outperformer here at almost 10% in the last month. And real estate doing pretty well, and telecom down quite a bit. And this is mostly driven by AT&T. I continue to receive dividends in this account, but I'm not actively investing any cash, just reinvesting dividends as it hits that $25 mark required for M1 Finance to reinvest your money. Looking at my higher yield savings account, it's up almost 1% over the last month. And again, still a pretty choppy market, but it is flatter because this account owns much more bonds. Looking at the holdings, again, short-term government bonds are down. The Vanguard Dividend Appreciation Fund is up pretty substantially. Realty income basically flat. Some of the bond funds are starting to decrease. And like I said, I think this is because people are starting to sell bonds because they're basically at all-time highs and moving that money into some equities on the dip. And the dividend investment funds that I have in this account and the dividend ETFs that I have in this account also did pretty well over the last month. Moving on to my options portfolio, I do a more in-depth review of this in another video. So definitely like and subscribe if you want to follow my options portfolio. But for this, I just go over the monthly gains, and you can see the month has been pretty good. This return does look pretty high because I did have more money in this account, and I've been moving it over to my Tastyworks account. But if you want to follow along with a smaller options account, this kind of growth is possible. And you can see over the last 2 weeks here, it's been a little bit choppy towards the end of last week and then the beginning of this week. And then looking here at my Tastyworks account, you can see I'm close to 28,000. It was up quite a bit from there, but over the last few weeks, the markets have been down and I was a little bit too bullish in this portfolio. So I took a little bit of a reduction there and I had to make some adjustments in order to reduce my downside risk. Finishing up with my biweekly tracker, you can see my stocks went down just a little bit. My trading accounts continue to rise, getting into that second place position. Most of this is from cash contributions, but it is a little bit of gains as well. Bonds are continuing to downtrend, as well as Lending Club. REITs are continuing to go up. And then I'm a little bit cash poor here. I'm going to slow down some of my investments just to get a little bit more cash. I like to have around $8,000 in cash. And right now I'm at 6,800, so I do need to slow down and get a little bit more cash on hand. Overall, I did turn a little bit of a profit over the last 2 weeks at 0.39%. Comment down below what you think of any of my investments. If you want to open an account with any of them, there are links in the description that gets you free stuff when you get started. Definitely like and subscribe if you got any value out of this video. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. Today's jelly is Mike Tyson's first song. It is an EDM song, and it's got this kind of weird music video to go along with it. So here's a few clips from that.
I've been the craziest, I've been outrageous. The vicious, the most destructive fighter ever lived. I'm Mike Tyson. an international star. I'm Mike Tyson.
Clearly, this song is pretty silly and pretty funny. Comment down below what you thought of it. If you want to watch the full video, there is a link in the description. Definitely like and subscribe if you got any value out of this video. Have a great day.